All right, sounds like the mics have been turned on. The Star Wars music has been turned off. It's time to return to our seats and have a little bit of quality earnings stimulation following the revenue recognition momentum of earlier this morning. We have an excellent guest speaker coming at 11:15 before I dive into our presentation. So Mark and I are going to try and keep this moving. In fact, those who know me well know that when I use notes, it's not so I remember what to say, it's so that I remember to not keep talking. So we'll go back to our notes to make sure we end timely to have our guest speaker introduced at about 11:15. But in the meantime, Mark Wolstoncroft and I, if those who don't know me, I'm Jeff Ford. Mark Wolstoncroft and I are excited to talk about quality of earnings reports. We're going to talk about two different perspectives, and perspective matters, and that'll be a little bit my role later, talking about the difference in perspective between a buy side and a sell side quality of earnings exercise. Mark's going to kick it off with talking about elements that are common to both buy-side and sell-side due diligence or quality of earnings reports, and focus a bit on some things that are a little more unique to the buy-side. Now, this has been around for a long time. Companies that have been acquiring other companies have been doing quality of earnings reports for decades, to be sure. We might have moved a little bit from agreed upon procedures to more of an MBA type of report 10 or 15 years ago, but it continues to migrate, and that's where you saw most of the action was on the buy side. But in the last 5 to 7, 5 to 10 years, there's a lot more activity on the sell side quality of earnings, and we'll get into why that's happened and so on. But because of that, and because of that difference, and because of the different timelines and different motivations, we thought it might be interesting to present that today. So as I mentioned before, Mark is going to kick it off, and we'll turn the clicker over to him.
All right. Thank you, Jeff. Okay. Good morning again. Before we dive into the similarities, I'm hoping you'll bear with me for two quick Pittsburgh sports analogies. After all, we have the City of Bridges theming today, and it seems only fitting that we talk a little bit about some Pittsburgh sports analogies. First, I want to do a little bit of word association as everybody finishes coming back into the room. And I wonder what you think of when I say back to back. To me, that phrase reminds me of a couple different Pittsburgh Penguins Stanley Cup victories. I have fond memories of the 91 and 92 Stanley Cup runs. And then, of course, we're all familiar with the more recent 2016 and 2017 success. Hopefully going forward into this year, we have another opportunity. And next year, we can talk about back to back to back. But the second thing that I think about when I hear back to back is a more recent phenomenon. And that's, again, around the Pittsburgh Penguins, but it's the 17 back-to-back series that they have this year. And for those of you who may not be as knowledgeable about hockey or as interested in hockey, that is a lot of back-to-back games to play, where you're playing one night in one city and the next night in another city. And more often than not, you end up losing that second game. So far, the Penguins have lost all 6 of their second games in back-to-back series. Their combined score in those games is 35-9. Not very good. This is the first time I've ever presented in back-to-back seminars. I'm hoping that it's not as brutal on me or on you as it has been on our 2017 Pittsburgh Penguins.
I'm just glad that it was a sports analogy. I was afraid you're going to move to this side of the podium.
Unfortunately, sometimes we have to, part of being a sports fan is watching some of your favorite players come and go. And obviously when you start to think about it, you think about players that have come and gone, players that you've loved, and then all of a sudden you hate them. And, really, Jeff was saying, this due diligence is a matter of perspective. And I felt a lot differently about Max Talbot when he scored the game winner in the 2009 Stanley Cup Series than I did when he came back 2 years later and was playing for the Flyers. I felt differently about Mark Recchi and Kevin Stevens when they played for the Penguins than they played for the Flyers. And I felt a little bit differently this year watching former Pirate pitcher Charlie Morton close down the Dodgers in Game 7 of the World Series. You know, they both played, all of those players played the same games. They used the same skill set, the same tools when they were playing for our team and when they were playing for the other guys. And so today, I'm going to talk a little bit about that skill set that you would use no matter what team that you're on. And then Jeff's going to talk a little bit about how it might differ, how your perspective might differ. So you can think about my presentation as talking about, you know, Charlie Morton's sinker ball that he's going to throw for both the Pirates and the Astros. And I don't know if John or if Jeff will invoke Barry Bonds or not, but he'll talk about some differences when they're playing for the Pirates versus another team. So let's talk a little bit about the similarities. And the first step that we're going to do in a lot of due diligence assignments, a lot of quality earnings assignments, is we're going to summarize the accounting policies and practices. That's important for a number of reasons. I mean, first of all, we need to understand the accounting policies and practices, to understand what's in the financial statements, to understand the impact on earnings, to understand the impact on the balance sheet. And we also want to understand what the significant estimates that are involved in the financial statements are. Obviously, when you approach a transaction, there are certain incentives, and it's important to understand where the weaknesses are in the financial statements that can be exploited for those incentives. For entities that are audited, you know, really, that process is a little bit easier because you have audited financial statements that already lay out the important accounting policies and procedures. You probably have a governance letter where the auditors have communicated to the audit committee or to the board of directors, here's where the significant estimates are in the financial statements. For entities that aren't audited, you know, that's a little bit more of a process because you have to interview the folks that are handling the accounting records, the CFO, the controller, the bookkeeper, et cetera. In either case, even if you have a nice roadmap in an audit, you want to make an independent evaluation of anything that might not be captured in the audit report or in the summary or in the governance letter. So since purchase prices are often driven off of either revenue multiples or EBITDA multiples, you know, and typically those are based on GAAP multiples, we'll see we're very interested in how do the financial accounting policies relate to GAAP. Are they GAAP policies? Are they different policies? As you might expect, in some of the smaller entities, and some larger entities, but you can see some interesting accounting policies. Of course, sellers of small businesses, sometimes their policies can be pretty tax motivated. And in those cases, you know, understanding the policies is important because they're going to want to, they're probably not going to want to count against their EBITDA their vacation expenses. They might have enjoyed deducting them for purposes of their tax returns, but they certainly don't want it to count against them in determination of the purchase price. And of course, the buyers are going to be looking closely at those accounting policies and looking closely at the EBITDA adjustments to make sure they feel that they're appropriate. So understanding those accounting policies and practices is an important first step for sure. Next, we also, whether we're doing a buy side or a sell side quality of earnings report, we really want to analyze a number of different areas. Some of those areas are listed here. Revenue recognition, of course, that ties in with the policies. That ties in with what we talked about this morning. But in addition to that, we may want to look at trends. We may want to look at what revenue recognition has looked at over time, understand changes, understand why revenue might be higher in this year than it's been in prior years. Hopefully that's not just because there's a sale coming and we've tried to enhance revenue. One way we get our arms around that is to look at monthly information, to look at shipping information, and we may want to evaluate cutoff as well. It's important to look at margins by product or customer or other different demarcations. That's important, obviously, if you have a lot of your margin that's tied up in one particular product, it's important to know. It's important to know if you're a seller, It's important to know if you're a buyer. If you have a lot of margin that's tied up with a particular customer, it's important to know. So a lot of times sellers will already know that. Sometimes it's important to recognize that yourself so that when the buyers come in, you have a defense for why that may be less important than the buyer wants to think it is. But let's get our head around, what some of the things that the buyer might challenge us on are. For SGA, or I guess also on the margin, it's helpful sometimes to look at the cost of goods sold line items and look at trend analyses there. I mean, you can see when you look at a 3-year horizon of information, and you see that in year 1 and year 2, there's a pretty consistent amount of supplies expense or a consistent amount of repair and maintenance expense, and then you get into year 3, which is going to be the measurement period for the deal. You have almost no supply expense. You have almost no repair and maintenance expense. It becomes clear that you might be trying to manage those expenses for purposes of the deal. And again, it's every seller is going to look for every opportunity they can to make EBITDA look as good as they can, but the buyers are also going to look at that and they're going to challenge it. It's good to know where you stand on those types of items. We want to understand, it's also sometimes helpful to understand what the potential efficiencies are after the deal. So let's say you're going to sell to a strategic buyer rather than a financial buyer. It might be helpful for you to think about what changes might they make after the deal, what value is that going to create for them, and what does that mean relative to the value of my business to them? Can I get a premium? What kind of premium might I expect? So it's good to think about what the advantages of that strategic buyer might be. On concentrations, of course, concentrations are important to values of businesses. Everybody thinks automatically about revenue concentrations, customer concentrations. Of course, a key part of diligence is often interviewing customers and understanding what the risks are there. You can also see significant margin concentrations, and so that's another layer that you can go into on concentrations. I've heard Jeff tell a story before about salespeople concentrations.
That story's coming up again.
Oh, I won't tell it then. I thought concentrations were on my time, but
that's all right.
We'll hold off there. You could think of that as a teaser. On the last 2 lines here, we're looking at balance sheet accounts. We're looking at receivables. We're looking at inventories. We're looking at fixed assets. And we're looking at the liability side too. When we're looking at these areas, we're really, again, you can do a trend analysis. It probably makes the most sense to focus in on things like reserves, allowances, accruals. Really what you want to keep your eye open for is a buyer is not going to like if you had a $100,000 allowance for doubtful accounts last year, you had no write-offs against the allowance, and you have a $20,000 allowance for doubtful accounts this year. Because that essentially means you reversed $80,000 of that allowance into income. So it's important when you're looking at quality of earnings to take a look at those reserves and allowances and see how they've been adjusted and see what the impact is on the EBITDA. We want to identify potential contingent liabilities, describe likelihood and potential impacts. Some of those might include environmental liabilities. Really, our role in environmental liabilities tends to be making inquiries and possibly, if there is a significant liability recorded, looking at the calculations for that liability. But generally, especially on the buy side, buyers are going to engage someone that's particularly knowledgeable around environmental liabilities and assessing the risks there. On potential product liability and warranty matters, if you have a routine business that routinely has product liability or warranty matters, a lot of times that's going to jump out when we're looking at the trend analysis of the reserves around that. But if there are particularly large or unusual warranty or product liability items, that's something we want to make inquiries around and understand the impact on earnings during the periods in question. Pension obligations is, I guess, one that's near and dear to my heart these days. Folks, you've probably seen in the news a lot about, especially multi-employer pension plans. I think most single employer defined benefit plans, a lot of those have disappeared over the years. But there are still a lot of multi-employer union defined benefit pension plans around. Most of them are underfunded. And so you see really on a lot of deals for companies that have these multi-employer pension plans, those pension plans are underfunded. And GAAP does not, interestingly, GAAP doesn't require that you have any liability on the financial statements for those plans until you decide to withdraw. So the plan might be underfunded, and everybody might know that somehow over time we're going to need to get more assets into those plans in order to fund the benefits, or we're going to have to cut the benefits. But it's important to know that that liability is not on the books. It's important to know what that obligation might be, and it's important to know, once you make the sale, how might that multi-employer plan, what might the exit might look like, and what might the cash flows associated with that plan look like. So it's not uncommon in the area, in the clients that we serve, to see a $500,000, $1 million, or a $2 million multi-employer plan obligation. So those can be some pretty big numbers to deal with in conjunction with the diligence. Our firm has a lot of experience with those plans, and we can help both buyers and sellers to understand the risks associated with those plans. I'll be honest with you, some buyers are kind of hands off on those plans. If you got a company with those plans, they're not interested in talking to you. And that may be because they don't understand the risks, and it might be an education process to help them understand what risks might be mitigated. But it also can be, if you're selling to a private equity firm, some of the private equity firms have concerns that that liability might creep into their other portfolio companies. So important thing to look at if you have a multi-employer pension obligation. And then we have kind of a catch-all category for anything else that might be excluded as a liability or other risks. We want to make inquiries around those and help to understand those.
Can I ask a question?
Yeah.
We just went through a sale when a big thing was on the tax side, like sales tax and corporate tax. In both my states, we were doing activities in a lot of states. We weren't really filing, we weren't really there, but it's a whole nexus issue.
Particularly if it's internet sales. I think Don Johnston would be delighted to tell you today that I think that we did very few of those 10 years ago, and I think he would say that we have done or are active in 15 to 20 such projects of that nature currently, and that would be both on the buy side and sell side. So sales tax nexus, particularly with internet sales or Amazon Prime, is something front and center. Not exactly the topic for this, but it is certainly front and center for even if you continue to own the company. Yeah. Yeah. It's an area of uncertainty, which looks like it will remain an area of uncertainty for a while.
But fortunately, there are some measures you can take if you're buying a company that has 20 years of unfiled tax returns. You can box that risk. I know there in a lot of the states there are filings that you can make, voluntary filings that you can make that'll limit that exposure to a 3-year period. So you don't want to walk away from a deal just because there's 20 years of issues. You might be able to cut that down. You still have an issue, but it might be a lot smaller. Hey, fellas in the back, I'm having trouble with my clicker. Would you mind advancing? Okay. I've also lost the slides up on these monitors, so we will. That's fine. We can continue. I'll let you folks work in the back to try to rectify. Next, we wanted to talk about required minimum working capital levels, and I just want to walk through kind of what the working capital negotiation looks like in a deal. I mean, a lot of times when you have a deal, the diligence work really starts in conjunction with the letter of intent. The letter of intent defines a purchase price. It generally does not address working capital. So let's say I agreed to pay a buyer $10 million for their company, and or I have a letter of intent to pay $10 million anyway. I want to mitigate, and let's say they're a $2 million working capital company. Historically, they've had $2 million of working capital. I want to mitigate the risk that between the time I agree to pay them $10 million and the time we close the deal, that working capital is going to shrink from $2 million to $1 million. Because if that happens, I basically am paying them $1 million more than I planned to. So a lot of times in these deals, you'll have a working capital target. So sometime between the letter of intent and the date of the deal, you'll agree upon a target. In this case, I would have tried to agree to a $2 million target. That way, when they delivered $1 million of working capital to me, I would pay them the $10 million purchase price, but I would reduce the purchase price by $1 million and only pay them $9 million. So we think that working capital number is an important number to look at. It's something that's often overlooked. I don't know if often overlooked is right, but sometimes it's something that's thought about later in the process because you're more focused on that $10 million number. So we'll help you look at working capital, what historic working capital has looked like. A lot of times I see on those deals that people are starting with kind of a 12 trailing months working capital number as kind of the starting point for the negotiation. But remember, if sales are increasing and your sales price is based on, or your purchase price is based on a sales number that looks like this, it doesn't make sense to use TTM working capital as your base. You probably want to look at something a little bit different than that, at least from an economic perspective. So again, looking at working capital is important both on the buy side and on the sell side. All right, thank you for rectifying the slides here. The next one here is on tax matters, and this goes along with the question that we had just a moment ago. So first, on the tax side, buyers are generally interested in buying assets, and sellers are generally interested in selling stock. That's because, for two reasons really. The buyer does not want to take on any historic liabilities that would be associated with the company, and also they get to use what they paid as the basis in the new company. Sellers usually want to sell stock because they get to offload the risk related to the historic period, and it's generally more tax efficient for them. So we can help in conjunction with the diligence process to figure out the best transaction structure for your deal, both what might be best for you, and then they'll probably come back and say, we want to do it the other way, and then we can help you determine what the cost of negotiating with them is. And then the last point on here I had on here was we can evaluate the tax exposure related to tax returns that have historically been filed, maybe inappropriately, or have not been filed to the point of the question we had earlier. If there are sales tax returns that have not been filed, we want to be able to determine and box that risk. I want to list and describe and evaluate the various EBITDA adjustments. I'm going to, the next slide, you're not going to be able to read it, but don't worry, it's just a picture, all right? But this is what a quality of earnings report might look like. This one's noisier than many. But at the top left, and I was told right before this presentation, I have a laser beam. So
we have a green laser beam. I will help. I will be your laser.
Oh, okay. Thank you. At the top there, the top left, we have essentially the unadjusted EBITDA. This is the reported EBITDA. Down the left-hand side, these are all adjustments to EBITDA. These are seller identified adjustments. So this is an example that relates to a project that I did 2 years ago. We were working on the buy side. So the seller had already engaged somebody to come in and do sell-side diligence, and they did a very thorough job. a lot of adjustments, and if you look, almost all of them are ads, interestingly. But so you have a bunch of adjustments to come down to seller proposed EBITDA at the bottom. And then we came in and we looked, and you can see seller proposed EBITDA at the top right. And then we had some adjustments that we found and that we proposed to come down to essentially what we thought was the pro forma EBITDA that should be used in conjunction with determining the price of the company. So when we're working on a buy side, we really want to be evaluating I don't even know how many were there, like 24 seller proposed adjustments. We want to be evaluating the reasonableness of those adjustments and whether they make any sense or not. And sometimes you might look at that list and say, well, that one's this is a $20 million deal, and that one adjustment is only $50,000. The other ones are bigger. Does it really make sense to look at the $50,000 item? Keep in mind, though, that if we're talking about a 10 times EBITDA multiple, that $50,000 adjustment that looks small on there is going to cost you $500,000 in the deal. So it's important to really do your homework on those and make sure they make sense. So on the left side of the equation, we're going to be evaluating whether they make sense, looking at the support. On the right side of the equation, this is where we evaluated their accounting policies. We found some things that we thought were inconsistent with GAAP and proposed some adjustments there. Of course, our report, in addition to showing you these items and the impact on each year, we would lay out the case for those and really have supporting analyses that demonstrated why those were appropriate adjustments. All right, and with that, I gotta catch up in my notes here. With that, I think we're moving. Oh, did we go backwards here, John?
I think we did. Oh, here we are.
Okay, very good. I'll turn it over to you for differences.
Okay. Well, just as the revenue recognition presentation team suggested this morning with the use of keywords, I have two keywords for you when you're looking at the differences between buy-side and sell-side Q of E. Those keywords would be perspective and objectives. And I want to just set the table before we walk through this with a couple of different thoughts. One of my literary heroes, Mark Twain, probably should have worked for the FASB because one of his many quips went as follows. Mark Twain pointed out that figures don't lie, but liars do figure. So we need to always be professionally skeptical whether you're doing this from either perspective. Furthermore, perspective differences can exist even within buy-side objectives. When we've done buy-side work, I've had some clients say, I really want to do this deal, look at it with one eye closed effectively, if you will, and just identify issues that are big problems, but please don't do or say anything that would spook the seller. And that's a perspective. Other times the buyer will say, gee, in order to outbid everybody else competing for this deal, I had to go a little higher than I wanted to, and we all know that the number in the letter of intent typically is much higher than the final number in either the asset or the stock purchase agreement. So sometimes they direct us to help close that gap between what they had to put in the letter of intent and what they in fact intend to pay. And obviously we're always looking at risks and avoiding surprises, as Mark touched on. So now, when you have this perspective difference, most people think, well, shouldn't just the amount be the amount? The amount is the amount. Aren't beans beans? And we're just counting beans after all, right? I would suggest that we're not. And I'll give one example with a single data point and then push towards multiple data points. Single data point is the old adage about if this thing is 50%, has a line at 50% of its contents, the buyer's negotiating team would be saying that that particular glass was half empty and thus a discount should be exacted upon whatever the price was yielded from the multiple. Conversely, the seller's team would be saying that very same glass was half full and accordingly a premium would be warranted. So different perspective, same fact set. And some people don't believe me on that, but businesses have so many different data points. The example I've been fond of using at the expense of my valuation teammates for years is just when somebody's looking at the same $50 or $100 million business, sometimes even the same business owner has a different perspective whether they're talking to their banker or their spouse's divorce attorney. So When you're applying several decisions along many points of a decision tree, by skewing a perspective either to the left or to the right will cause you to land in a very, very different place. And that's really what we want to be thinking when we go through this. So first we're going to start with audiences. The audiences tend to be different, and in fact the teams tend to be different, and they kind of go together. With a buy side, the audience is usually limited to the buyer and their advisors and maybe their lenders or other investors. So it's a pretty limited audience. And work paper access, if we're doing buy-side diligence, is usually limited to that inner circle and not provided to other outside parties by any stretch. And in fact, the team tends to be that inner circle of buyer's legal counsel, buyer's acquisition team, et cetera. You have a much broader team and a much broader audience on sell-side diligence. Sell-side diligence is usually intended to include several potential buyers and their advisors, and it's usually intended that even our work papers together with the other providers' work papers would be made available to the advisors to those potential buyers. More and more, you're seeing 2, 3, 4, and in one case that's coming up for us, I think 5 people will come through the gate and 5 firms will be doing concurrent due diligence. So obviously that company has a good bargaining position, but nonetheless, that changes the way you organize the project. The project is now organized in a way that we have different areas in the files. We have the files set up in anticipation that multiple parties are looking not only at our report but our working papers. But we also have separate areas where we're keeping information that would be more limited to that inner circle, the seller's team. Now, perspective also drives differences in the approach. Mark talked a lot about the buy side and things that you're doing. You're looking at the price adjustments, using negotiation points, and among other things, even evaluating the target's personnel. Since he covered that so thoroughly, I'm going to jump to sell-side perspective. So the sell side has a really interesting perspective of several examples here. The sell side really wants to identify risks early so that we have time to deal with them. Maybe, just maybe, we want to resolve them. Maybe we could fix them and make them go away before the SIM or the confidential information memorandum is put together by the investment banking team. Well, how about that? The investment banking team is an integral part and often the initiator of sell-side due diligence. And they're usually sometimes the adversary on buy-side due diligence or feel a little bit that way. So we want to work closely with them so that they could tidy up the SIM a little bit or resolve issues ahead of time. We want to describe the issues. We want to discuss the impact. We want to be able to tell the story ahead of time of any mitigating factors, why it's not as important as it looks. We want to basically seize control of the dialogue, or at least initiate the dialogue and hopefully have control of it. I'm well aware that in the field of negotiation, there's an adage that said, he who speaks first loses. But there are times when any platitude doesn't always apply. And I think in this case, and in a lot of others, the one who can start the dialogue and spin the dialogue first gains control of the so-called high ground, and then is in a somewhat advantaged position, all other things being equal, than if the other side had the opportunity to initiate that dialogue. So sometimes this communication is even used to vet the buyers. If you have a strong bargaining position as a seller, you can say, you can't even come through the gate. You can't be part of the final 5 if you don't already agree to tolerate my multi-employer plan, tolerate my concentration, this, or the other thing, or whatever it may be. And then, and of course, time desensitizes all things. I need to come up with a new analogy because those who've worked with me in these projects know I call that Clintonizing it in reference to Bill Clinton. And if you get something ugly out there early and talk about it enough, by the time it really comes to close a deal or negotiate it, it's so old news, the emotion has been exhausted, and it doesn't seem to be as big of a deal anymore. Or you could say, we've been talking about it for months and months and months. Go away, I'm not changing my price. Now, the problem I'm having with that reference is that I'm now dealing with folks who are of the age that they never remember President Bill Clinton. So sometime in the next year, I'll have a new comparison to illustrate desensitizing an issue. So now we have several things really there to highlight as far as examples. And again, this will help keep me short. With regard to inventories, well, Mark certainly said you'll be looking at inventories and accounting methods. Well, what have we found on sell-side projects? We found a lot of companies who are tax motivated, so they don't like to absorb conversion costs in inventory, right? It's better to deduct it right away. So, but we also know that that'll be an issue when the buy-side teams come in. So we've helped some identify just exactly how narrow that absorption could be. You look at the absorption by product line or by different area of production or whatever the case may be, and you try and narrow it, and then you use turnover rates to diminish the impact. So good tax planning sometimes yields an opportunity for buy-side diligence. It's our job on the sell side to mitigate that. We aren't necessarily even changing the policy. We're just putting right in the sell-side Q of E report the impact of their historical lack of absorption of conversion costs in the inventory. Certainly, the more obvious things are if they can't take an accurate inventory, you have time to fix it. That's the resolution thing. And we've seen that maybe more often than you think. And it often happens when the company's done an ERP conversion within a 2, 3, or 4 year a visibility cycle from a transaction. Well, Mark talked about my concentration stories. So now I have customer concentration stories and employee concentration stories. So in a customer concentration stories, most of you would know that a customer concentration is high, a company's more at risk if 80% of its revenues come from one customer than if it comes from a plethora of customers. So what do you do about that? Well, you decide how to tell the story, how to mitigate that risk. So Eric and I worked on one recently that had just this horrible looking customer concentration. We read the SIM before we got there to do the sell-side Q of E, and we thought this was just going to be an ugly issue. But as we're sitting with the investment bankers, talking with management, talking with the production people, we come to find out that while this customer concentration is really there, the relationship is in fact with the company to company, not any given individual. And in fact, this potential seller had so ingrained themselves in their customer's production process and procurement process, they've, over a period of decades, in a very successful company, by the way, put themselves in a position where their customer was more dependent upon them than the other way around. The cost of exit for that customer would have been essentially prohibitive. So that allowed what looked like just a very difficult situation in the first draft of the SIM to be spun as what it in fact was, a very positive situation. So basically, we turn a negative, we mitigate it, we clarify it, honest, direct, and respectfully, and it turns into a positive. Well, the concentrations that Mark was talking about have to do with salespeople, and I have 2 salespeople concentration examples. In both cases, a single salesperson had over 70% of the sales underneath their umbrella and owned those relationships. That sounds relatively frightening, right? So in situation number 1, the one that was a little easier to deal with, we said, what are we going to do about this, and so forth. And it was actually investment bankers that twisted the arm of the would-be seller and created some relatively lucrative golden handcuffs, if you will, to really bind that key salesperson to that company. And the investment bankers were also able to articulate that in the SIM, and we, of course, also articulated it in the Q of E report. And it very effectively mitigated that situation. In fact, the investment bankers had smiles because they had an auction environment that yielded a higher multiple than I told them would have been sane, so they had fun teasing me about that. On a similar fact set, there was another case of where we're also in the sell side, 70-some% of the sales with one salesperson, and I think this is probably the Mark story. And that gentleman in this case, the first one happened to be a female, the second one is a male. That gentleman was 76 years old. Yikes. We usually don't use the word yikes in a Q of E sell-side diligence report, but we were having trouble coming up with something other than yikes. He was a nice guy. He was a capable guy. He wasn't a particularly, he wasn't exuding health and vitality. So you couldn't say, if only we were in his shape when we were 76, you couldn't say any of that. So they basically took the 2 things. They took a relatively lame plan to mentor, and they took a desensitization approach. They started introducing all the prospective buyers to him on their very first tour, and they somewhat desensitized it, but by and large, they did take a little bit of a lump on the valuation with that. So that's a big thing to remember. Well, what about the price adjustments that Mark was talking about? I won't dwell on them because he talked about finding the different price adjustments and evaluating what the sell side did. But he showed you that big table on the left-hand side of all those sell side EBITDA add backs. We will argue with a prospective company who's thinking about sell side diligence, we'll make the argument that if we were doing the buy side work and we found all of those add backs, we would certainly tell our client who's engaged us to do the buy side about all of those positive EBITDA add backs, but we might forget to tell the seller. Or our buyer's lawyer will probably preclude us from telling the seller about those positive EBITDA add backs that they hadn't identified on their own. And where do you see those? You see those in a lot of areas Mark mentioned, but one of the key ones that so often comes up is unrecorded assets. The amount of money that many private companies have locked in tools and dies and tooling and things like that can be amazing. And if we find it on the buy side, mum's the word. If we find it on the sell side, it's in the SIM and it's in the QOV report. So you have those are, again, neither being disingenuous, just difference in perspective. And Mark touched on the working capital, and the working capital is absolutely key. Working capital, by the way, is usually a dollar for dollar adjustment, as many of you know. There's however many times EBITDA or whatever your cap rate is on net operating income yields some dollar amount. And then usually there's this like plus cash minus that stuff that goes on. And then oftentimes there's another adjustment for a minimum working capital level. You got to seize the high ground on the sell side and the working capital adjustment because so often, particularly a private business owner who's very successful, and this is another one that Eric and I saw, a multi-decade private business owner, very successful manufacturing company, selling price was going to be somewhere in the 30s. And he just so enjoyed this business and was so risk adverse, never had debt, admitted that he made more money than he knew how to spend, which is a good place to be. And as a result of that, if you looked at trailing 12 months working capital, it was several $1 million above where it needed to be. Why do you keep all this cash in the business? So my kids don't spend it. Okay. Look at your receivables. They look pretty good. Okay, we won't adjust that. What's with all this inventory? Everything we've talked about over all these days says that you could get by with a lot less inventory. I have fun with the inventory. The inventory and these machines are my playground. Okay, now let's take a breather for a week. Let's let you talk to the investment banker, and let's talk about how much inventory you actually need for the revenue volume you have. And it ended up shaving several $1 million from the working capital as analyzed. Now, any buyer would see that, any buyer would have taken advantage of that, and we're pretty sure that most buyers would not accept quite as the aggressive posture the investment banker took with that minimum working capital, but it was much better than having not done it in the first place. So we also have the opportunity from this perspective approach to actually just change the structure of things. Mark talked about tax structure and other structure, but sometimes we want to carve elements out of the deal. One case, now this is getting a few years back now, there was a company that has intellectual property. They developed a technology that was very disruptive, very helpful. And their $5 million investment yielded them offers from the market in the 130s to 140s, so they were very happy. All of those buyers were focused on the one application in the market to which they've applied this technology. There were 3 or 4 other applications that they've never tried to commercialize. So the suggestion was made, gee, why don't you just carve out those alternate uses for the same IP and keep that for yourselves? Because all these buyers, they don't even want that. And they were successful in doing that. It's an open question how well they monetized that, but nevertheless, that was an opportunity early on to affect some structure changes in areas other than just tax. So what about the assessment of the company's personnel? Well, we're certainly doing that on the buy side. And on the sell side, you really have a chance to coach them. You really have a chance to see them in action because we pretend to be the buyer. We actually take, sometimes the antagonistic role in role playing to see how they perform, to see how tight their information is, to see how professional their people are, to see how cooperative they are. Because interestingly enough, not all personnel and every seller are invested in the deal as much as the seller, the owner, might be. Some controllers of some companies look at it and say, this is the best job I'll ever get in this small town. So accordingly, I may not be as effusively positive to a buyer's diligence team as maybe the seller would be. So you're really trying to see what they're about, how capably can they stand up to buy-side diligence, and where it's helpful to insert some other teammates in the process to either coach them through or mentor them, or sometimes, a couple of times, we've even become the primary point of contact. Certainly the investment bankers are that more often than not, but sometimes they've asked that we would be the primary point of contact in conveying basic information that's requested from the buy side. So that becomes a very fascinating part of the process. Another part of the process that's also fascinating is you give the seller time to augment their team. You sometimes expose the fact that many well-run businesses run very lean on personnel. If they're a little bit too lean, you give them a little bit of time to patch that up or desensitize it if need be, and really help the seller's personnel get through that. Well, what about timing? Timing is a very different perspective. Buy side is one of those things that's always urgent. It's always hurry up, stop, hurry up, stop, hurry up, stop. And it's usually done between the letter of intent and the closing. And usually it's very time critical. And usually it's a little frenzied as a result of that. On the other hand, the sell side, if planned properly, allows a lot of time between the first draft of the SIM and the release of the information memorandum to the marketplace. That gives a lot of time to do what we've talked about before. It gives a lot of time to kind of reset the stage, to redo things, and it really drives some of the values of the process. Remember, if you're the buyer, the value of the process is to reduce the risk of surprises, to identify opportunities, et cetera, et cetera. If you're on the sell side, we want to help with speed to close. So we certainly want to help speed the close. If you already have this done, you've done some of the work for the buyers. They're still going to do it, but they'll be hard-pressed to say they need as much diligence time as they would if you haven't done it. We want to find the surprises. We've already talked about the fact that the buy side wouldn't necessarily mention the positive ones. We want to control the dialogue. But now a very funny thing often happens here. And this has happened a little bit to the disappointment of some of the investment bankers who, in fact, may initiate the work or refer us the work. Sometimes, just sometimes, when you're going through the sell-side diligence, the buyer says, this isn't such a bad company. This starts to look a lot more like love it or list it than just prepare ourselves to withstand buy-side diligence. Now, from our perspective, we understand from the investment banker's perspective that that probably delays or costs a meaningful payout. And I've seen the modified Lehman scales. I know those payouts can be relatively meaningful. But from a seller's perspective, it allows them to say, you know, this 30 or 40 or 10 million or whatever the number is going to be subject to tax. I realize that our tax group or other tax groups would knock that down. And then it's going to be invested with your favorite investment advisors, and it's going to yield some single-digit number. Sometimes that seller is reading these different reports, and they scratch their head, and they say, look at my return. If I can still tolerate this business, if I can convince my son or daughter to come into this business, we will have a far superior return. Or I might do some sort of leveraged recap and take half the risk off the table and do something like that. So one of the key benefits that's usually not stated in sell-side diligence is really affirming the decision of the seller, so they don't have that seller's remorse. Some of them are delayed while they think about that, and some of them then have more comfort in moving forward than they would have otherwise had. I'm going to bring it to a close relatively quickly because, as I mentioned, we do have an exciting speaker, and I will not even use all of my 2 minutes and 8 seconds that I have remaining. There is an example in your handout of some of the deliverables. Mark put one page up, but these deliverables can be hundreds of pages, or they could be 50 to 100 pages. The deliverables are intense. But as important as that deliverable, which goes to your banker and other advisor, would be access to the data, the work paper access, the conduit of information, but also the verbal interaction. There's a lot of things that can be said verbally that probably ought not be put into an email or into a report or, for goodness sake, onto Twitter. So a lot of the most valuable insight comes in the verbal interaction between the buyers and sellers. And a lot of that insight comes as a result of interacting on the same team with the seller's personnel with an openness that wouldn't necessarily be there if you're on the buy side. So I think that's an often overlooked perspective on that case, and many other things that may be required by certain cases at hand. So we are a service firm. We operate on budgets. I finished 1 minute ahead of budget. And with that, Bob Grossman is going to come up and introduce our esteemed guest speaker.